Okay, you guys, in Chapter 9, we're now going to look at long-term liabilities. So a couple of types we'll look at, some notes payable that stretch over more than just the current year. So they would be, as far as notes payable go, you guys, the portion that we expect to pay back within 1 year, the principal part of the note that we expect to pay back within 1 year would be a note payable current portion, and it would be grouped with current liabilities. But the principal part of a note that we expect to pay back in years 2 and beyond, the principal portion there would be considered a long-term liability. So with a note payable that covers, say, a 5-year period, we have to split that between current liabilities and long-term liabilities. So the portion we expect to pay back within 1 year, the principal part there would be a current liability. The principal portion we expect to pay back in years, let's say 2 through 5, would be a long-term liability. I hope that makes sense. I think it probably does. But here we're going to look at some notes payable that stretch beyond 1 year. So on January 1, 2024, Let Us Eat sandwich bar, I wanted to say salad bar, borrowed $90,000 for 4 years at 5%. The loan requires 4 annual payments of $25,381. They're saying round our computations here to the nearest dollar, and that payment is due annually. So instead of a loan like probably a lot of us have, where we make monthly payments, this company is borrowing $90,000, and they're going to pay it back in 4 annual payments. So they want us to fill out this amortization schedule for the loan. So in the beginning, our carrying amount of the loan, or the amount it would be shown at on the balance sheet, would be $90,000, the amount borrowed, right? All right, so let's just pull the chart on down here. Okay, cash paid on at the end of December 2024 would be this payment amount, $25,381. And we're going to pay that amount every year. I don't know why, but I like for these to be centered. Just just one little part of what's wrong with my brain, probably. But anyway, it just makes me feel odd if they're not centered. Now that payment amount, you guys, is going to be the same each year, so we can go ahead and fill that in. $25,381 each year is the payment amount. Now, what do we know? Part of that payment amount each year will go toward reducing the loan balance. That's the principal part of the payment. And then the other part of the payment will go to the lender as interest revenue. For Lettuce here, the borrower, it will be interest expense. So let's look at that. Interest for 1 year on $90,000 at 5%. Let's see if I can move my. There we go. All right, so we got $90,000 times, it's exactly 1 year, so we can just multiply by the interest rate. So the interest portion of the payment in 2024 is $4,500. And then the decrease in the carrying value, or what I would call the principal portion of this payment, will be the difference in the payment and the interest expense. So I'm going to change that to a negative amount and then subtract it from the $25,381. So the principal portion of this payment is $20,881. And that's what we'll subtract from the $90,000 carrying value to get the carrying value at the end of 2024. And again, carrying value, or the carry value here, I typically say carrying, but that's the amount the loan would be reported on the balance sheet at. So it's 90,000 minus 20,881. So again, I'm just going to hit this plus minus button to change that to a negative amount, and then add the 90,000 to get our difference here. 69,119 will be our new carrying amount at the end of 2024. All right, so now we'll say 69,119 times 5%. 34.55.95. Now it said round that to the dollar, so let's go with 34.56. Always pay attention to those instructions because sometimes it might want you to carry it out round to the penny. So out of this payment, 25,381, 3,456 of it is interest expense for lettuce here, and would be interest revenue for the lender. And the remainder of this payment would go toward reducing the loan balance. So again, let's turn this, I'm just going to clear it out since we're rounding that one up. It's going to be 25,381 minus 34.56. So our decrease in the carrying value this time is 21,925. $21,925. Okay. And then we'll subtract that from the 69,119. Gives us a new carrying amount of 47,194. You guys notice here, as we go along and the carrying value decreases, the interest expense portion of the payment also decreases. So, you know, in early years of a loan, especially on like a 30-year mortgage, your monthly payment, very little of that goes toward reducing the balance, and almost all of it is interest expense to your mortgage holder. But as you get toward the end of that 30 years and you're making some of your last payments, almost all of the payment goes toward reducing the loan balance, and very little goes toward interest expense. And why is that? Well, the balance of the loan that we're multiplying the interest rate by is constantly decreasing. Okay, so let's keep going here. 47,194 times 0.05 gives us 23.59. We'll round that to 23.60 for the interest portion. All right, now that needs to be subtracted from our payment amount to get the decrease in the loan balance. So I'll say 25,381 minus 23.60, 23,021 here. Now we'll subtract that from the 47,194. And that gives us a new carrying amount of 24,173. Now we'll multiply that times our 5% interest rate. And that gives us 1,209, we'll round it to. For interest. So now we'll subtract that from the payment. 25,381 minus 1,209 Gives us 24,172 as the decrease in the carrying value. And then when we subtract that from the carrying value, here we end up with $1. But you guys, it's essentially zero. It was $1 rather than zero because of our rounding difference. I'll leave it as 1, I guess. But anyway, that bugs me for it to be 1. I want it to be 0 because we're at the end of the loan and they now owe nothing. So I am going to leave it at 0. But know that that $1 difference is just due to rounding. Also know, at least in my class, or I think in most of our classes, you're probably not going to be counted off over $1 either way, especially on an amortization schedule, because that rounding does come into play. And you guys, you can use this type of thing on the month-to-month to calculate a mortgage payment or a car loan payment, that kind of thing. All right, so now let's do the journal entry. You had to know what journal entry was coming. So let's do the journal entry to record the loan at its inception or the day the loan was taken out. So Lettuce there would debit cash $90,000 and credit notes payable $90,000. It's probably familiar to you from our current liabilities chapters. That part's the same. So the asset cash increased by $90,000. Our liabilities increased by $90,000, and that's cash coming in from a financing source. All right, now they want the journal entry to record the payment at the end of 2024. Well, you guys, you got everything you need to do that right here. Okay, so we're going to debit notes payable for the decrease in the carrying value, $20,881. Looks like we've started here instead with interest expense. It doesn't matter which one you debit first, but if you start with interest expense, we'll debit it for $4,500. It's an expense that increased. And the interest expense would be an operating activity. The note payable is going to decrease by this amount. The decrease in the carrying value, liabilities decrease on the debit side. And then we're going to credit cash for the $25,381. Now the interest expense, you guys, is an operating activity, but the note payable is a financing activity. See, I'd like to have a space here to put that in, but I'll just do it here. That's cash going out for a financing activity. And that's the note payable part, or the decrease in the note payable is the finance cash going out for a financing activity. Remember, the principal part we pay back is financing. The interest portion is always an operating activity. All right, and then what happened here? What are the financial statement effects? Well, our expenses increased by $4,500, causing net income and stockholders' equity to both decrease by $4,500. The liability, notes payable, decreased by $20,881. And then cash, the asset, decreased by $25,381. Notice that balances. If you add these two together, that'll balance the accounting equation. And our note here, cash flow would be split like we already talked about. The $4,500 outflow would be from operating activities, and then the $20,881 is a financing activity. Both outflows of cash here. All right, and that's it for that one. Thanks for watching the video, and as always, if I can help you, please be in touch.